Good evening, everyone. A very warm welcome to all of you to this special session on integrated business solution paper organized by Board of Studies Academic. Today, we will take you through some quick insights into jewelry industry, which is one of the most fascinating and resilient sectors, especially in India. Jewelry here is not just a fashion, it's a culture, tradition, and even a form of investment. Globally, the jewelry industry is valued at over $350 billion, and India alone contributes close to 30% of global consumption. In fact, India is among the largest consumers of gold in world. Weddings, festivals continue to drive demand, but what's interesting is the shift we are seeing from traditional heavy jewelry towards lightweight jewelry design that appeal to younger generation. There are three types of trends. Number one is digitalization. Consumers can now explore catalogs online, use AR, VR to virtually try jewelry, and even customize design digitally. This is a major shift from old walk-in store model. Sustainability lab grown diamonds and recycled metals are being adopted worldwide. Customers are asking, where did this stone come from? Is it ethically sourced? Shift to branded players. Companies like Tanishq, Malabar, Kalyan are gaining market share because of trust, hallmarking, and professional customer service, which smaller unorganized players struggle to match. Okay, however, this sector is not without any challenge. Volatility in gold and diamond prices affects margin. Regulatory requirements like compulsory hallmarking and GST compliances increase cost. The industry is still heavy fragmented with a small players competing mainly on price, which makes it harder for them to scale up or invest in technology. But the opportunities are equally strong. India is a global hub of diamond cutting and polishing, exporting to US and Middle East. There's strong growth potential in Tier 2 and Tier 3 cities where branded jewelry chains are expanding. And technology from AI driven customer analytics to blockchain for gemstone traceability will further transform the way jewelry is bought and sold. In our previous sessions, we have explored diverse real world industries to understand how strategy and compliance go hand in hand. In fast fashion, we looked at how lean supply chains and short product cycles create competitiveness. In aviation sector, we discussed how airlines balance operational cost while sustaining growth. In FMCG, the role of branding, customer insights, and efficient logistics came into focus. In tea industry, showed us challenges of agri-based supply chains, sustainability, and market volatility. In transportation, we explored how app-based logistics and mobility platforms are reshaping delivery and commuting models. Across all these examples, one common message standouts. Strategic decisions cannot be seen in isolation. Strategic decisions cannot be seen in isolation. They must be evaluated through holistic lens covering financial viability, regulatory compliances, risk management, and long-term value creation. And this is exactly what the integrated business solution paper emphasizes, helping you as a future professional to connect strategy with substance and performance with purpose. Today, we will look at two very interesting case studies from Case Studies Digest. The first case study is on listed company in India's jewelry retail sector. The company is engaged in trade, manufacture, and sale of diamonds, precious stones, and diamond stud jewelry. This case gives us a wide coverage on Ind AS 24, Section 15(1) of the CGST Act, the Product Life Cycle Model, SA 550, Regulation 2 of SEBI LODR 2015, Section 276 of Companies Act, and also principles of transfer pricing. Okay, this will allow us to connect both strategic and compliances issue with industry realities. The second case study is from Super Specialty Hospital. This one covers India's 21 on foreign currency, Section 278 of on Companies Act, Regulation 23(2) of SEBI LODR 2015, India's 116 on lease, as well as McKinsey 7S. Both of these cases are excellent example of how technical standards, regulation, and strategic models are connected with each other. All study materials are already uploaded on students portal. I strongly encourage you to review the material. Today's session will be interactive and you can ask your question at any point either directly in Hindi or in English by typing them in chat box towards, and we will also reserve about 15 minutes for open questions from your side. We are honored to have CA Nilanjan Paul sir, partner at BDO, and a highly respected chartered accountant with vast experience in auditing. His expertise will guide you in bridging classroom learning with real business challenges. With that, let us begin today's session and dive into these insightful business cases. CA Nilanjan Paul, sir, over to you.
Thank you, Deepak, and good evening to everyone. It's great to be able to connect with many of the new aspirants in this wonderful course that we call the CA course. And I also want to thank Deepak and ICAI in particular for giving me this continued opportunity. So, as Deepak mentioned, we would like to have this discussion in a two-way communication. At any point in time, there is some clarification on the topics that we're going to discuss. Please feel free to ping or raise your hand, and we'll try to find out some responses to your questions. Uh, in this particular topic that we're going to have, there are two case studies, as Deepak mentioned. And the primary theme, if I have to tell you, is about identifying related party transactions, right? And from a practical side, related party transactions and related party relationships in particular are looked at by various regulators and various standard setters from their point of view. So these two questions will be a culmination of the point of view or the perspective of various stakeholders, especially the regulators and financial statement users, uh, when they look at related party transactions, right? So I hope you find this to be quite engaging, and please feel free to ask questions wherever you see a need to be. Yeah. So I have shared my screen, and yeah. So yeah. So we'll talk about the first case study, which is Diamond Limited. It is, as Deepak mentioned, it is in the business of gems and jewelry. It is a listed entity in India, and they have a very wide presence in terms of the market that they cater to. They have a mix of traditional as well as modern jewelry. They're also solitaires. They're also certified diamond jewelry, right? So they have a very wide portfolio of offerings. It is jewelry, it is wedding jewelry, party wear, across various occasions. As a group that generally operates, they have a wide set of group entities, be it subsidiaries, joint venture associates. They have a decentralized management structure where the operations are delegated to individual components, right? As a result, there is a good amount of autonomy, right, which they see, and they also see it as efficiency drive across the group, right? One very important aspect when you decentralized power or roles and responsibility is it expected to fasten the decision making process. Imagine a scenario where each and every decision has to be done by a single person or a group of persons sitting some remote corner of the group. The proximity to the decision maker and the executor is sometimes challenging. So decentralized power enables that gap, and it kind of breeds efficiency across the entire group. So that's how the business structures are generally in a real life. Now, as far as this entity is concerned, Diamond Limited, it is audited by a firm of chartered accountants called Amit and Amod, right? And they had been appointed for the statutory auditors for the financial year 2024 and 25. And when their risk assessment uh, uh, procedures have been carried out, they have identified related party transaction, which are common in business operation. They have identified this to be an area which is prone to risk of material misstatement. And also to some extent, they have assigned a risk of fraud, right, in related party transactions. Now, as you would recall, if there is a risk of material misstatement, and especially if there is a fraud risk, the auditors are supposed to have a heightened degree of professional skepticism and apply judgment in assessing that they have identified or they've carried out sufficient appropriate audit evidence to mitigate the risk of misstatement. Now, as far as the fraud risk is concerned, the auditors are also supposed to employ anti-fraud procedures to specifically mitigate the risk of fraud. Now, as a first step, the auditors have felt that it is important that they connect with the CFO. So they wrote an email to the CFO, who is Ms. Ratna Malik, and requesting for a comprehensive list of related party and the related party transactions. So I think this particular case study is already hosted on the case study digest. For the purpose of our discussions, we have not uh, been able to replicate the entire case study, but we have kept the significant portions of that case study for us to discuss. And those particular extracts have been put in front of the individual questions so that we are able to have a very seamless kind of a discussion. So even in this particular scenario, when they have asked for a list of related party and related party transactions, we're putting it forward the relevant portions which are important for us to discuss. So if you would look at this slide, there are on the left hand side, this is the response from Ratna Malik, who is the CFO. So she has talked about a list of RPTs which are identified by the auditors Amod and Amit, and they have and Ratna Malik on the right hand side uh, have given her responses. So, for example, for Sapphire Limited, which the entity has identified a related party, and there are observations of the auditors, right, regarding certain matters. And we'll also deal with these aspects in some time. But I felt it to highlight the perspective or the questions which the auditors have sent to the CFO. Similarly, on the right hand side, Ratna Malik had provided the organization chart or the group chart for the entire group. So if you would see on the right hand side, Diamond Group is the listed entity, which is the ultimate parent, and they have a diverse set of entities. So you have Coral, you have Emerald, you have Sapphire, you have Ruby, you have Jade, you have Zircon, you have Topaz, you have Amethyst, and you have Retail Gems. So again, in front of every entity, you have also been provided with the list of shareholding and also the relationship which Diamond Limited have with the various group entities. If a particular group entity, for example, Coral, have a step down entity, for example, in this case, a Diamond, which is a JV to the Coral Limited, that have also been mentioned, right? So on the left hand side, just to be absolutely clear, is the observation which the auditors have identified, and right hand side is the response which has been given by the CFO. To start off, she has provided the list of entities along with the group chart. Okay, let's deal with these questions one by one. We'll start with Sapphire Limited. So Sapphire Limited is a subsidiary of Coral, right? And that is the question that will first pop up in the screen. So the first question is Sapphire Limited a related party of Diamond as per Ind AS 24? So Ind AS 24, from an accounting standards point of view, deals with related party and related party relationships, right? So if I have to go back to the previous slide, we're talking about Sapphire. Sapphire Limited is a joint venture of Coral, right? And Coral is a subsidiary of Diamond Limited. So when I ask this question of what is the relationship of Sapphire, I am asking in the context of Diamond Limited. So in the financial statements of Diamond Limited, what is the relationship between Diamond and Sapphire Limited? So mind you, Diamond holds a subsidiary, which is Coral, and Coral, below that entity, we have a joint venture called, it is a subsidiary of Coral, right? Diamond Limited has a joint venture called Coral, and Coral in turn has a subsidiary called Sapphire, right? So Diamond Limited holds 50% of Coral, and Coral Limited holds 51% of Sapphire. So from a Diamond Limited perspective, it is a joint venture. Sorry, it is a subsidiary of a joint venture. So now, if I take you back to the question, whether the entity Sapphire Limited is a related party under Ind AS 24 of Diamond. So again, we have four options, and one of them is the correct option, right? So as we discuss, I would like you to look at these four options, and when we're through with this question, I would like you to post your response on the chat. So let's see what is the first option. The first option is yes. Sapphire is a related party of Diamond. Okay, because under Ind AS 24, Sapphire Limited is a joint venture and a subsidiary of a joint venture under Ind AS 24 is a related party. That is option one. Option two is yes, again, Sapphire is a related party of Diamond Limited because all step down subsidiaries at second level, okay, all step down entities up to the second level under Ind AS 24 are by default related parties. So we have Diamond, and after that we have Coral, and after that we have Sapphire. Since Sapphire is at the second level, one argument is that under Ind AS 24, it is by default a related party. Third option, that yes, it is a related party because under Ind AS 24, all step down, right, at second level are also related parties. Third, or the fourth option is that yes, under Ind AS 24, Diamond Limited controls the subsidiary, that is Sapphire, right? That is of a joint venture. So you have a joint venture and then you have a subsidiary. One argument is that the listed entity Diamond controls the ultimate subsidiary, which is Sapphire. So Diamond Limited through the JV controls the subsidiary, and hence this also becomes a, a, a related party for the ultimate parent. So I'll take a pause here and I will request all of you to post their responses. If there is a particular question or clarity that they need, please feel reach out to me. Yeah. So I want to see some responses. Sheetal, Sanjay, Chitra, if we have some point of view, do let me know. Saurav. So Swaminathan believes that it is option A. Okay. Any other response? Anyone? Okay. So let's see what is the correct response. Yes. Correct response is option A. That yes, it is a subsidiary of a joint venture, right? That under Ind AS 24 is by default a related party. So it is not because it is a second level. It is not because it is controlling through joint venture the subsidiary of a joint venture. That is also an incorrect reason. So let me explain these options why they're incorrect one by one. So if I have to talk about the fourth one, which is basically this, right? That through a joint venture, the listed entity is controlling its subsidiary. I think this option is incorrect because when you have a joint venture, you don't control that entity, right? So in our example, if I have to go back, right, Diamond Limited doesn't control Coral, right? It has a joint control, right? So when you have a joint control, Diamond Limited cannot exercise unanimous right over this control. They can't direct the use or they cannot direct or operate Coral Limited the way they want, right? If there is no control on this, right, so then obviously they can't control an entity below, which is Sapphire. So then that option is ruled out. The another option was that the second level entities are by default covered under Ind AS 24. So again, that is an incorrect option because there is no such level under Ind AS, right? Be it first level, second level, or third level, there is no such bifurcation. Ind AS 24, as we all know, it is based on the principle of reciprocity, right? And we have another question to discuss the principle of reciprocity, which basically means it's generally a mirror kind of a transaction or a mirror kind of relationship, right? So if one entity is related to another, say vice versa also follows. So let me tell you why the first option is the correct option. Now, if you are a subsidiary, right, which is Sapphire, is a subsidiary of Coral. Economically, Sapphire is no different or no distinct than Coral, right? So if you might say that Sapphire is a separate legal entity, but under Ind AS we go by substance and not by form. So economically, Coral Limited and Sapphire Limited, though they are established as a separate legal entity, economically they are the same. So they are considered as one entity. So if Diamond Limited is a joint venturer of Coral, it will also be a joint venturer of Coral plus Sapphire combined. So there is no legal distinction. Accordingly, this particular option, which is option one, is appropriate, right? So are we clear here in this particular uh, question? Because I do know the finding the relationship between parties under Ind AS 24 sometimes can become challenging. But what message I want to pass on to you is that whenever you are stuck with a question, look at whether economically they are controlled by the same party or economically they are one, right? So I might have a associate in between or a joint venture in between, and below that there might be another subsidiary. So in days 24, I think they go beyond, they go by substance. And if there is a subsidiary below an entity which is not controlled, both for the perspective of Ind AS 24 are considered as one, right? So I thought I'll put that reason in front of you. So, and this is the response broadly what we discussed. If I have to go by specificity, right, under Ind AS 24, right, uh, a joint, a subsidiary of a joint venture is covered. So it is paragraph 9b, subparagraph 2, right? Similarly, paragraph 12 of Ind AS 24, it covers joint venture to include its subsidiaries. Therefore, the subsidiary of a joint venture and the investor has joint control over such joint venture. So again, broadly in line with whatever we discussed. Are we clear? Can I have a thumbs up if there is if this question is clear, or if there's some doubt? I am ready to take some questions. Okay. Okay. So now let's move to second question. Okay. Now we're talking about a non-monetary compensation which Ratna Malik is getting. Ratna Malik, as we know, is the CFO, right? Now, she is a KMP because you carry out the roles and responsibility of a very senior kind of a management. Now, as a part of her compensation, she uh, she gets a company car, okay, which is for the purpose of business. Now, few details are quite relevant. The purchase price of the car is 380 lakhs. Okay. Now, if I look at the valuation for the perspective of Income Tax Act, that is around 35 lakhs. Because under Income Tax Act, there are certain rules where you can value a company provided car as a part of your compensation. So assuming as far as the Income Tax Act is concerned, the perquisite rules, they value this perquisite as 35 lakhs. Okay. Now depreciation that I have recognized in the financial statements for the year is 76 lakhs. Okay. So I would just like you to keep these three things in mind: purchase price, perquisite under Income Tax Act, and depreciation recognized in the financial statements. Now the question is, when you talk about a transaction with KMP, non-cash transaction, uh, is there a value based on which you would need to disclose that in the financial statements? So again, we have four options. One is that we show the purchase price of the car, 380 lakhs, as the amount for related party non-benefit transaction to a KMP. Second is that I show the amount of perquisite under Income Tax Act. Third is that I show nil because they are not getting cash compensation, they're getting a non-cash compensation. And this is also for the performance of official duties, right? Fourth option is that you recognize depreciation as the amount for RPT in the financial statements. So again, I will take a pause and I will request all of you to put their responses on the chat. So is the question clear or you want me to repeat the question? Differently. Why is it not nil? Because you're not paying any cash to that KMP, which is Ratna Malik. Why is it not nil?
Because we are giving that perquisite in lieu of services provided by that person.
But it's still nil, right, Viva? There's no value attached.
Hmm.
Any other thoughts?
Sir, I go for option D, the depreciation recognition in the financial statement, that is 76 lakhs, because the first option, purchase price, anyway, purchase price is now ruled out because it's already depreciation is recognized in the financial statement 76 only.
Okay.
And also value perquisite is as per the valuation rule of that income tax. This is
Okay.
nowhere related to the accounting purpose. So I go for option D, sir.
So Swaminathan, why not option one? Because I still have a carrying value recognized in my financial statements, right? 380 minus 76 is still appearing in my financial statements under property, plant, and equipment. So why not that value?
The reason is because it's a non-monetary benefit. Its actual cost is not applicable on that case. Whatever the depreciation recognized in the financial statement would be appropriate.
So let me ask you the question differently. If I go by option D, right, then every year I'll be showing a compensation to that person. So if you would add up over a period of time, you will reach to 380 lakhs only. So why not on year one we disclose the entire 380 lakhs as my related party transaction? I'm not saying what your response is right or wrong, but I'm trying to pose the question differently, right? 76 lakhs year on year you will recognize. Ultimately, you will reach to 380 lakhs, right?
Yes, sir. As per the company books, it will reach to that. But when we are disclosing up to the point, the particular year, the year is in the first times no that we have to disclose at 7 days only. See, when on the cumulative matter, when the year is passing on, then
Yeah.
it will cross.
Yeah. Okay. Okay.
Can we
Good.
take matching concept into the picture?
Matching. Okay. Can you explain that?
Like services, we are essentially claiming depreciation for 76 lakhs every year, and hence whatever considered it as something like salary only. So
Sure.
it is over the period. Since it's over the period for the services rendered during the period,
Yeah.
so jab tak uska benefit we are taking deferred, so then we should take the valuation of that transaction also as per the depreciation recognized.
Sure. I think Viva, that's the point which was I was trying to ask Swaminathan, right? It might add up to 380 over a period of time, but what is it that I'm giving? Even from the perspective of the user, right, which is Ratna Malik, CFO in our case, she will be using this car over a period of time, right? So what I have done, instead of giving her cash, which through which she would have bought a car, right, and that car will be used for, let's say, 5 years. I said that I will buy a car, and then you use it for 5 years, right? So you're exactly bang on that this is like a prepayment, right? Which I have done. 380 is the cost which I have recognized in my financial statements as a
Right.
in very very crudely put, a prepayment of my salary.
Right.
And through this, I am giving, as and when she is rendering services, she is becoming eligible each and every year, a part of that prepayment,
Right.
right? So I think you and Swaminathan both were right in your own way. But I want you to appreciate that when you look at these kind of related party relationships, they first of all don't go by amounts, right? If you would recall, under Ind AS 24, they have also said that even you are not charging a price, you still need to disclose that as a RPT. So the third
Right.
option is anyway ruled out. So there has to be a disclosure. Only because you're not charging, that doesn't mean, right, that there is no related party transaction. There is a related party. Now the question is at what price, right? So I think fourth is the correct one, because as and when you pass time, there is a passage of time, you keep on rendering services and you are eligible for that benefit. You are like drawing that benefit, right, over a period of time, right? So I
Right.
think you both are right to say that option four is the correct one. Yeah. So let's see some technical literature. It is para 9 of Ind AS 19, right, which talks about non-monetary benefits, right? Uh, they have said that if it is a remuneration for a KMP, right, it would include an estimation of the benefit that has been provided. Again,
Right.
I would like to caution all of you, they have not laid out a particular method of how to estimate that benefit, right? So the most common or the most reliable method would be to pick up the amount of depreciation, because again, depreciation is a flux of time, wear and tear, obsolescence. That is one method through which you have recognized the use of that PPE when you are operating your business, right? It is covered under the accounting framework, and it would be highly satisfactory if you would consider an accounting framework driven number to give a disclosure in the financial statements, rather than you then finding out another non-GAAP measure, right? So I think that is what the standard is trying to articulate, that you look at in days 24 and in days 19, which kind of gives you an example of how to recognize a non-monetary benefit in the financial statements, right? Is that clear, everyone?
Yes.
Okay, thanks.
Yes, sir. Thanks, sir.
Okay, so let me see, there is another chat. uh, okay, yeah. Let's move to another question. Now we're talking about an entity called Jade. Okay. Now, if you would look at Jade, Jade is basically a associate, okay, of an associate. So here I am Diamond. I have an associate called Emerald, and that associate has a further associate called Jade. Okay, I am the auditor of a Diamond. Now, Diamond and Jade Limited, there is a transaction, right? Now, the question is that whether this transaction requires approval under SEBI listing regulation. So again, if I have to simplify this question further, the first question is whether Jade and Diamond are related parties under SEBI listing regulations. So now you're moving away from accounting, where we're trying to identify RPT under SEBI listing regulation. If they are related parties, then the second question is whether this needs to be approved by the audit committee of Diamond Limited. Because under regulation 23, right, any transaction by the listed entity with its related party would require prior approval of the audit committee, right? So let's deal with the first question. Yeah. Do you think, again, Chitra, Swaminathan, Viva, do you think Jade and Diamond are related party as far as SEBI listing regulations is concerned? Okay, let me simplify this a bit for you. And we'll take one by one. SEBI listing regulation is a summation of three requirements. If the entity is a related party under the Companies Act, then you are also a related party under SEBI. If you are a related party as per Ind AS, only Ind AS, not Companies Act, then you are also a related party under SEBI. If you are not a related party under Companies Act, not under Ind AS, but you are a deemed related party under SEBI, right? Then you are also a related party under SEBI listing regulation. So as you can see, the definition of related party under SEBI is very, very wide. Okay. So if you are qualifying as a related party under in any of the three boxes, you are a related party under SEBI listing regulation. So let's start with the first one. Okay. And I want you guys to put some responses on the chat. Do you think whether the first criteria is met? Whether under the Companies Act 2013, Jade Limited, which is an associate of an associate, will be a related party as per as the definition of Companies Act is concerned. Yeah. Viva, Chitra, Shital, Sonakshi, Swaminathan, Sanjay. Okay. Chitra says no. Okay. Can I ask Chitra, why do you think it is not covered under the definition of Companies Act? Anyone for yes? Anybody believe that it is covered under the definition of Companies Act?
What is the percentage involved, sir, in that?
I think it is 20%. So Diamond Limited holds, let's say, 20% in the associate, and the associate also holds 20% in Jade.
Okay. It's between the associate and that joint venture, right?
It is the transaction between the step down associate. So let me take you back to the chart, right? It is a transaction between Diamond and Jade.
Diamond is that ultimate, okay.
Diamond is the listed entity, ultimate investor.
Yeah,
It
that is
has,
ultimate parent company.
yeah,
This
yeah.
what Z is, what is the position is associate. Yeah, as per that company side, it is a related party, sir.
So Jade is an associate of the associate Emerald.
Okay, that's not a matter, sir.
Okay, okay,
It will be treated as a relationship is there.
okay, okay. Any other thoughts, anyone?
But between the associate, that Emerald and the Z, no, there is no relationship.
So Emerald
Um,
is an investor on Jade. So between Emerald and Jade, Jade is an
uh,
associate of Emerald.
yeah. Even there will be the relationship will be excite. But
Yeah.
if the other party, if there is any associate, in that case the relationship does not exist.
Okay. So what's your
But this
final
is
answer?
a
Do
my
you
answer
think?
is, yeah, I agreed with there is a related party transaction is exist in
Okay.
between the Diamond Limited and the Z Limited.
Okay. Okay. Okay.
Even the Emerald and between Z also there is a related party transaction.
Okay. And you're saying Swaminathan in the context of the Companies Act 2013, right?
Yes, sir.
Okay. Okay. That's great. Any other thoughts? Okay. Okay. Let me ask the question again. We spoke of Companies Act. Now, is it also a related party under Ind AS 24? We had three definitions, Companies Act. We have some views. Let's deal with the second part of the question, which is SEBI, which is Ind AS 24. Whether Jade Limited and Diamond Limited are a related party under Ind AS 24. Mind you, we're talking about an associate of an associate.
I don't think those will be a related parties, Diamond and Jade under Index 24.
Okay, why is that, Viva?
Because I think it specifies a relationship between the company and the associate, and even if there's a subsidiary of such associate, but it does not specify that an associate of an associate would be a related party.
Okay, fair point. And what about the Companies Act, Viva? What do you think? Is Jade?
I don't think that it's a related party in the Companies Act as well, because it only provides for the company and its associate. It does not say that associate would also be a related party.
Okay, okay, okay. So do others have any differing thought from what Viva spoke? Sonakshi, Sheetal, Saurav, Sanjay.
Yeah, I agree to Viva's point on this case, sir. Actually,
Okay, 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 okay. So now let's unravel. Yep. So that's the beauty of our regulations, right? We have, as I said, from the start, we have various regulators looking at related party from their own lens, right? So the first red box or the red circle, Companies Act 2013, it stops at one particular level. Okay, it does not extend to an associate of an associate, right? So under Companies Act 2013, it's a very rule-based definition. They have listed out which all entities are related parties under the definition of Companies Act 2013, right? So if you would see on the slide, they have talked about holding, subsidiary, associate, fellow subsidiary, right? KMP, all that. As far as the associate of an associate is concerned, it is not covered here, right? For an associate, they're stopping at the first level, which is only associate. If we would talk about subsidiary, the definition of subsidiary also includes a step down subsidiary. So if you have multiple layers of subsidiaries, those are in the definition of a subsidiary. But the moment you talk about associate, the regulator has stopped only at the first level, which is an associate. Another very interesting point which I want to highlight is that these are all in the context of a company. Okay, so when the Companies Act definition is there, they are of the view that associate company should also be a company. Okay, so if you have an LLP, again that is ruled out from the definition of Companies Act 2013, right? So net for your simple understanding, for associates and joint venture, they have stopped at the first level. They have not got beyond that. Okay, let's see what does Ind AS say. Ind AS again is based on the definition of reciprocity, right? So we have talked about co-ventures. So if there are two joint ventures, co-venturers, if there are two joint venturers, then they are related parties among themselves. Group entities, right? Parent, subsidiary, fellow subsidiaries, they are related parties. The first level associates, joint ventures are also related parties, right? Entities which are under the control of joint venture, that is also covered. But again, I think Viva mentioned that very aptly. Associate of an associate is also not covered under Ind AS, right? And I think there is a very great logic to that. As you could recall in the first example, we equated a subsidiary of a JV as one, right? It is economically one entity. But in this entity, in this example, if you would look at, we're talking about an associate of an associate, right? So an associate will not be able to control JD, right? So economically also and legally also, these are two distinct entities, right? It can't be controlled, right? So from a Diamond Limited perspective, they only have significant influence in the intermediate associate. They don't have significant influence over JADE, right? So again, JADE is also ruled out from the definition of related party under Ind AS, right? And if I have to talk about specifically under Ind AS 24, paragraph 12, they have said that that an associate of an associate is not a related party. Yeah. So again, these are SEBI specific definition, which is not right. So net, none of them are related parties. Okay. Is it clear to everyone? I know it is a bit of a complicated kind of a scenario, and it might be very confusing to say that they are not RPTs, but I thought I'll just put that point in front of you.
Yes, sir. Yes, sir. It's good to see that this is the first time I'm comparing between that company side Ind AS and the SEBI LODR.
Yeah. So I think, Swaminathan, this is the exact reason why we're having these discussions, right? And IBS is one such place where you will find a culmination of various requirements to look at from a very, very different perspective. Okay, so that's how is my day job. That's what I look at from a day-to-day perspective, right? Is it clear to everyone, or anybody wants me to repeat? Happy to repeat.
It's clear.
Okay, great.
Sir, what is the condition for that SEBI situation, sir, LODR situation?
So SEBI, Swaminathan, there are 2 or 3 very rule-based conditions. They have said that it has to be a part of promoter or promoter group, or Diamond Limited should hold 10% or more of equity shares of directly or indirectly. So here we're talking about 20% of 20%, right? So again, or directly or on a beneficial basis. So again, let's assume that these conditions are also not met. The idea was to show it to you that I might have a transaction with a particular entity which apparently seemed to be a related party, but it may not fit in any of the definitions given under the accounting standard or under laws and regulations. Yeah.
All right, sir. Thank you.
Yeah. Okay. Now let's move from accounting to a tax question, right? So we're talking about Zircon. Zircon is here. It is a subsidiary of Diamond, and they have sold some stuff in March 25, right? They have sold it for 20 lakhs. Now, if they would have sold the same amount or the same goods to an unrelated party, they would have sold it for 25 lakhs. So this transaction of 20 lakhs is not at arm's length. Okay. Now the question is, as far as the GST rate is concerned, or what should be the amount of you know uh, determination of the value of supply, right, to compute GST. So again, we have four options. We have invoice value 20 lakhs. We have 90% of the price charged. We have value of supply of any kind, which is 21 lakhs, which is cost of supply is 20.9 lakhs, or it's an open market price. So again, the question is, what is the value of supply under the GST norms? Again, I will request all of you to put your responses. Mind you, we're talking about a transaction which is lesser than the market price. So I've sold it at 20. The market value is 25. Any thoughts, anyone?
Nice value. So first, that the rules is that the related part transaction is not first. You will see the open market price.
Okay.
Here, the open market price is given,
Yeah.
and if not that case, we will go for likely goods. The service and the value of supply of likely goods and services is also is there 21 lakhs. And if that is not a case, then we will go for 110 percentage value.
Okay.
Mm,
Is there option available, Swaminathan? In
when I am looking at that option, that 3 is right, and 5 is also okay. 5-3 combination is not there, and 4 is also there. 4 and 3 will be appropriate, sir, I believe.
4 and 3. So which option is that? Option C.
Option C.
Okay. Anybody else? Okay. So let's see what is the option. You're right. So Swaminathan, it is option C. Let's see the reason. Okay. And I know it's a long reason, so I'm pausing here for everybody's reading, and then we will discuss. So if I have to explain this a bit further, right? There's an option, right, that you choose the open market price or 90% of the price charged, right? So that is as per the valuation rules under Rule 28 of CGST. Zircon is also not eligible for full input tax credit, right? So in a way, we're talking about option 2 or 3, 4 and 3, right, are the options. So I think it is clear in the CGST rules, Rule 28, Section 25, subsection 4 and 5, right, where the value has to be found out based on open market price. If the open market value is not available, then it's a separate set of rules, right? So one of that rule is that you choose it to be an option of the price charged, 90% of the price charged. So then I have an option to go for opt for either the open market price, which is 25 lakhs, or 90% of the price charged, right? That is valuation method rule 28. Is it clear to everyone?
Yes.
Yeah. Swaminathan, is that okay?
Yes, sir. Thank you.
Yeah. Okay. Okay. We are 7:32, right? So let's take the next question. Is it about preparation of related party disclosure? Again, this might be a bit difficult to discuss over uh, uh, electronic mode, but I felt that why don't we have a quick discussion on how to present related party transactions in the financial statements. So we have these few transactions in March 25 and March 24, right? And we would need to disclose this in the financial statements. If you would recall, under Ind AS 24, there are a specific set of requirements that needs to be disclosed, right? One of them is that you have to disclose the name of those entity, the country of incorporation, the equity interest, and the principal business activity, right? But mind you, that requirement is only for subsidiaries, right? Because subsidiary, you have a very wide set of information that is already available, because as I said, subsidiary is nothing but an extension of the parent. So economically, you would be knowing each and every transaction that you would be entering. So that's the reason we have a requirement to disclose the name, the principal activities, the country of incorporation, and the equity interest. That is for subsidiaries. As far as associate is concerned, you would need to explain the interest held, which in our case, 25% in Emerald. You also need to disclose how much you is to hold in the prior year, which is also 25%. And if there is a step down entity, that also needs to be disclosed. So again, if you would see, the disclosure is limited to Emerald, which is a subsidiary of an associate, right? We are not covering associate of associate, which was Jade in our example. Similarly, in case of a joint arrangement, which is in Ind AS 111, or a joint venturer, which is Diamond, it holds 50% interest in joint venture Coral, and Coral in turn holds 51% interest in subsidiary, right, which is Sapphire. So here also we are stopping at a subsidiary of a joint venture. Okay, that's how the disclosure will look like in real life. In financial statements under Ind AS 24, I have to first of all categorize the broad type of transactions. So we have sales, purchases, and that too for different categories: purchase of PPE, purchase of goods, that is shown separately. Uh, Purchase and sale of goods from associate and its subsidiary separately, joint venture and its associate separately. The remuneration that we have paid, 76 lakhs to the KMP, that also is shown separately. So if you would look at from the requirement of Ind AS, and that is what you could see at the bottom of the screen, it shows that Ind AS 24, para 24, requires a similar nature to be disclosed in aggregate, except where separate disclosure is necessary for understanding the financial statements, right? So they permit some kind of an aggregation, but they also require a very transparent disclosure so that the information is not obscured, right? So again, purchase and sales are to be shown separately. They can't be aggregated. Purchase of goods and purchase of property, plant and equipment has to be shown separately, right? So again, this is for your information. This is how the transaction will look like in the financial statements. Okay. Now let's move to a different topic itself, which is basically a sustainability and life cycle costing. Now, Diamond Limited, they were trying to uh, develop something, right? It is called Aurora. It was trying to develop a particular product, and they have employed a life cycle costing approach to see the cost that is incurred over the period of time, right? So again, I would request all of you to think and put your response. What is the aggregate cost that I should be considering for life cycle costing? So again, we have 4 stages. We have design, manufacturing, operations, and end of life stages, right? So we have 1, 2, 3, 4 options. So I think these are self-explanatory, and I will take a pause for you to understand and let me know what is the total cost for the purpose of life cycle costing.
Sir, could you please show the original that costing structure?
I think that will be difficult, but we can discuss when we go to the responses. I know, as I said, that putting too much information can also be damaging. So let me take you to the response itself, and then we can discuss. Right?
Yeah, okay. Because no, without seeing
Yeah,
that,
yeah. I
yeah,
understand. Yeah, I understand. I understand.
I'm not there that much super duper.
So I think, as I said, it will take some kind of a some time to work this example out. But as you could see on the screen, we have design, manufacturing, operation, and end of life stage. If you would recall from the life cycle costing, it starts from cradle to grave, right? From the time it is designed till the time it is disposed, the entire cost over the entire life cycle is considered for the purpose of assessment, right? So if you would look at the design stage, I have incurred 600, which is under research, development, and design. Manufacturing, I have material, labor, overheads, training, maintenance. Operations, I have distribution and warranty. And end of life, I have disposal and cleanup cost. So what we are trying to highlight here is that at this point in time, it is not the cost of manufacture. So if I would have done an inventory valuation under Ind AS 2, I would have probably stopped it here, right? But here, if you would look at the concept of life cycle costing, as the name itself suggests, right from design to disposal, the entire cost should be considered, right? So in this example, I would have incurred 2845 lakhs for the purpose of this particular product Aurora, and that should be considered for my sustainability initiatives, right? Yeah. Okay.
Right, sir. Right, sir.
Let's move to an audit type question, because I come from an audit background, so it is important that I also put some audit questions. Now, there are also some concerns about audit procedures over RPT transactions. Okay, so under the related party standards, there's a example that undisclosed related parties could be an area of risk, right? And I think the auditors in this current example have also identified that kind of a risk. So if you would look at the responses, what are the procedures that they would carry out? They would need to first of all consider the auditing standard 550. They deal with the auditor's consideration on related party identification and also testing of transactions. So auditors, to identify undisclosed related parties, they should look at informal documents, they should informal arrangements, contracts, and assess whether they have considered all parties. Right. Most importantly, they should consider whether there is a dominant influence that is exercised by a particular party. Right. They should also send out legal confirmations, bank confirmations, corroborate with other documents, for example, minutes of the meeting, third party confirmations to look at completeness of the related parties. Now, if there are undisclosed transactions, they should be informing the management very, very clearly. They should investigate the differences. They should identify substantive procedures. If there is a risk of fraud, they should also see how this is mitigated in the audit procedures. If not, what is the risk in the financial statement? So, in a summary, you should look at the requirements under SF 550, which will tell you about identification as well as to deal if you have undisclosed related party transactions. Yep.
Yes, sir.
Yep. So I think this is an absolutely opportune time for a break. We are at 7:43. Maybe we'll break for 10 minutes and then we can resume. Is that okay with everyone?
Yeah,
Yeah,
well,
fine, sir.
Okay, thank you. Yep. case study. This time it is not gems and jewelry, but it is about another the theme of questions would be very similar to what we discussed in the previous case study, which was related party and related party transactions. But here you will find a bit more uh, transactions from an accounting standpoint. So in this particular fact pattern, it is a mix of related party as a topic and also some other concepts of accounting. Very interestingly, we'll also try to discuss the McKinsey 7S concept. And I know there could be some challenge in putting the entire fact together, but we'll at least deal with that in a very, very concise manner. Okay, so we're talking about Riddhi and Siddhi. They are siblings. They are very concerned about the environment. They study gastroenterology, kidney transplant, and critical healthcare uh, exchange. And they have various branches, or they call it as SBUs, or strategic business units, human capital, and they have our and technology adoption. Now, in one of the instance, they are transacting with an entity called USA Chemicals, and that entity is domiciled in USA, right? That entity, USA Chemical, they actually manufacture and sell life-saving drugs. Now, what happened is that Rishi Limited entered into a contract, right? And I would like you to note the terms of the contract. It involved 2 cartons of drugs to be delivered on 1st of October. Sorry, that's the date when they entered into a contract. Now, as far as the contract is concerned, they paid an upfront deposit of 40,000 US dollars. So on 1st October, which was the date of contract and also the date of giving the deposit, the conversion rate was INR 100 to 1 US dollar. Okay. Now, another important thing is that the item was delivered on 31st of January 2025. Why is this date important? Because they follow a calendar year. So for the year ended December 25, right? They have a delivery made after the year end, right? So at the point of time of delivery, which is 31st of Jan, the conversion rate was 160. Now it was a deposit. Deposit was like an upfront payment, and this was to be settled in the on the purchase of goods. So they will deduct 40,000 US dollars, and remaining amount was paid on 28th of February 2025. Right. So 2 or 3 dates which I want you to note. One, they paid an upfront deposit before the year end. Second, the actual goods was received after the year end. Similarly, the remaining amount, which is 60,000 US dollars, was paid after the year end. Right. Now, the question which I'm trying to pose to all of you is that, what is the at what value should the purchases be recognized in the financial statements of USA Chemicals? Is it at option 1, the conversion rate of giving the deposit, which is 160, or at the time of the year end conversion rate, let's say 160, or what is the value at which it should be recognized? Yeah. Any thoughts, anyone? So there's a question on Ind AS 21, which is basically the foreign exchange.
It is only we given the deposit amount on initially, but
Yeah.
goods delivery taken after the year end, right?
Yes.
Which means the deposit amount it's a kind of monetary.
Ultimately be used, against the purchases. It is like advance. It's a prepayment, right? Option 2 is to recognize the foreign currency deposit at 60 lakhs, and talking about the conversion rate on the date of settlement. Okay, both deposits as well as the liability at the date of settlement. Okay. Third is to recognize the deposit at the year-end rate, which is 44, and recognize foreign currency payable at the date of delivery. Okay. Or the option is 4, which is to recognize the foreign currency deposit at the date of giving deposit, and the trade payable is not recognized.
Okay.
So basically, at what point in time do you have a liability, and whether this is a monetary asset or not, and at how should you reflect that in the financial statements? So it is the question of change of point in time and varying rate of exchange.
Okay. Sir, but generally that the monetary items usually we will value at the closing rate generally.
Yep.
But here in this case, particularly that liability is not recognized. Only we given the deposit only.
Yep.
Okay. So why we have to? I think that deposit rate would be the appropriate. I believe option number D we can give.
Last option.
Since the last option, because that liability is coming later.
Yep.
Like what we do on the equity shares, we will recognize at the initial time. We will not do any revaluation later.
Okay. So
So
any other thoughts? Sonakshi, Sital, Saurabh, Sanjay, Chitra. Okay. So I think, Swaminathan, what you said is absolutely right. Okay. Um, but what I wanted to clarify, and this is a very common misconception, that whenever you have placed money, right, it is generally seen to be a monetary asset. Okay. So if you have made payments in advance, monetary asset to be that advance to be a monetary asset, it means that it has to be converted back to you in cash. Here you will not receive cash back, right? Here you will receive goods. So instead of you recognizing a liability first, you have made a prepayment of that goods, right? So in substance, these particular advance amount will be consumed as and when the goods are delivered. So you will not get a cash refund. Rather, you will get a non-monetary item, right? Which is goods. So even though this item will appear as a part of your loans and advances in the financial statements, these are not monetary items and hence should not be translated at the closing rate. Okay, they continue to be recognized as a non-monetary item at the date at the rate on the initial recognition, right? So at the time of deposits, whatever is the exchange rate, that is what I had used to recognize the amount of advance payment. Right? Am I clear? Is there some confusion?
Yes, sir. Clear, sir.
Okay, great. So this is a very common question or a very misconception I have seen that people have in mind, that they generally equate a foreign currency advance to be a monetary item. If their advance is not to be refunded back, but would be adjusted against purchase of goods and services, they are akin to a non-monetary item, right? And hence they need not be translated again at the year-end exchange rate. Yeah. Let's take another scenario: managerial remuneration. Okay. So during the year, uh, the company had paid a remuneration to the CEO, Ms. Nidhi. Ms. Nidhi is also a chartered accountant with a very deep experience in a particular subject. Okay. One of their compensation structure is ESOPs. Okay. So and their granted value is 100. Vesting exercise is at nil price. Okay. Second tranche, 3,000 ESOPs were granted at the beginning of the year. It would vest at the end of the next year. Right? So now the question is that when you are talking about managerial remuneration, I would like you to recall that managerial remuneration is covered under Section 198 of the Companies Act, right? And hence, there are particular rules and regulations which gives you the maximum amount of remuneration. Now the question is that when you talk about ESOP, how should ESOP be valued in uh, the computation, right? Again, a similar set of questions. Should I follow the option which is there in my financial statement, or is there a particular requirement under the Income Tax Act, right? Or is there a particular methodology which is given under the uh, uh, Companies Act 2013 itself? So I'll again share my screen and I'll maybe pose the options in front of you, right? So the main question is that how do you consider ESOP, right? I don't want to get into too much complexity in this question, but the moot question is when you talk about ESOPs, right? How it should be considered for the at the time of vesting, and the charge is recognized as per the accounting requirement, or is it that you have to use the requirements of the Income Tax Act, or whether they are not recognized at all, right? So again, I will take a pause here, and I will ask and I will request each one of you to put your thoughts in the chat on how do you recognize ESOP cost while computing managerial remuneration. Any thoughts, anyone?
Sir, I'm not very clear on this, but as per my assumption, odd man out, I can go for option A.
No problem.
Maybe check for my best luck.
No problem. Okay. So let me explain that to you. It is option A. But how do you get to that option? Right? So let's forget all these limits and computation. Okay. So if you might have a cost which is recognized in the financial statements over a period of vesting, but if that option is not exercised or the ESOP is not exercised, you would add them back for the purpose of ESOP cost. Okay, so I will add that ESOP cost back. Yeah. So again, as I said, and the requirement under the section 198. If you would look at the definition of remuneration under the Companies Act 2013, you can see here at the cursor, which means remuneration in form of money or its equivalent given to any person and includes perquisite as defined under Income Tax Act. Okay, rules, and they are not the PBT as per the financial statements. Add back whatever ESOP cost that I have recognized as per as the accounting is concerned, and reduce section 198. I'm not getting into too much of the limits because I think that limit is quite clear. If you compare these limits with the profitability limits under the Companies Act, that is overall 11% of net profits, and to whatever amount we're paying in this particular scenario is within that limits. But the idea of this example was to highlight that my regulatory requirements in some cases might be very different from accounting and vice versa. We saw those scenarios under the related party definition also, right? Here is another example where there is a divergence between the accounting requirements and the requirements of laws and regulations. Is this aspect clear to everyone, or is there a need to repeat? Let me know. Yeah. Okay. Now let's move to another question of RPT assessment under SEBI listing regulations. Okay. Now we're talking about RISI Limited, which is the listed entity. It is entering into a contract with an LLP called SIRI Limited to purchase certain materials. Majority of the capital of SIRI Limited is held by IRIS, and again an intermediate holding company, whose majority capital is held by Vani, right? That is incorporated by the friend of Riddhi. So Riddhi, as we know, is one of the director promoter of RISI Limited. She has, he has a friend, right? She has incorporated an entity called Vani. Vani holds majority capital in Iris. Iris holds majority capital in Siri. Okay. And now Rishi Limited and Siri Limited are having a transaction. Right. Another important fact, Iris Limited holds 5% of share capital of Rishi. Now, the terms and conditions is that initially 10,000 kgs of material will be purchased. Subsequently, 50,000 of material will be purchased. Right? Now, the question is whether the transaction is a related party transaction or not. So, to reiterate and to clarify again, the listed entity is having a transaction with an entity where the friend of one of the director holds majority of capital, right? So in that case, do you think it is a related party transaction under SEBI listing regulations or not? Again, these are the 4 options. I would like you to just spend 5-10 minutes because these are quite explanatory, and then I would request you to put your responses on the chat. So as you can see, there are four options on this slide, right? Two of them are yes and two of them are no. Are we all conversant with the SEBI norms of related party? If not, do let me know. Then I would be able to explain the requirements.
Yeah, please once explain, sir, please.
Okay, no problem. So let's forget the options. So this is basically the requirements under SEBI listing regulation. Now, what we also discussed in the earlier slide is that if there is a related party, right? And we saw that under the SEBI listing regulation, it is a very wide definition. It is a if it is a related party under Companies Act, if it is a related party under Ind AS, and if it meets certain conditions specified by SEBI. A combination of all three would lead to the answer that it is a related party. Now, similarly, we have a definition of related party transaction under SEBI listing regulation, which is basically regulation 2, sub-regulation 1, ZC2. Okay, so it's a very long number, but to cut the long story short, we have regulation 2, sub-regulation 1, which will tell you the definition of an RPT. Now, one of the very important criteria of related party transaction under SEBI listing regulation is that even though the transaction is carried out through a web of entities, right? But but the promoters or the related part or the main entity, listed entity, is ultimately getting benefited, right? That under the requirements of SEBI listing regulation, that is also an RPT. Okay, so let me repeat. If a transaction has happened through various channels within the entity, but ultimately it is benefiting the promoter of the listed entity, then by default, for the purpose of SEBI listing regulation, that transaction is a RPT, right? So it is kind of a different from the way we disclose in the financial statements. So financial statements, we establish related parties and a transaction with them are shown as RPTs, right? But here we're saying something different. We're saying that for the purpose of SEBI listing regulation, even though you are not an RPT, but it can still be an related party transaction if the purpose and effect is to ultimately benefit the promoters of the listed entity. And this change has came not that recently, but is still very untested in that sense. It has come up from 1st April 23, right? So if you would look at the requirements under regulation 1, if the transaction involves a transfer of resource or services between a listed entity or any of its subsidiaries on one hand, and any other person or the entity on the other hand, the purpose and effect is to benefit the related party of the listed entity or its subsidiaries, then it is an RPT, right? So what they're trying to say, actually see, is that don't say that it is not an RPT only because you are artificially placing certain legal entities in between. Ultimately, and you do I need to repeat?
Okay, thank you, sir.
Yeah. Any other thoughts, anyone? We have around few more participants. Sanjay, Chitra, Saurabh, Sital. Is there some confusion or clarification? Do let me know. Okay. Now let's talk of certain other uh, conditions or certain other requirements, right? These are again from the question of strategic management and improvement of market position, right? So again, there are various deliberations, right? So it is whether to continue with a current free structure or to make it more dynamic. What should that be an update of mission and strategic objectives to incorporate profitability, innovation, and ethical practices? Whether there is a need to revise approach for partnerships and collaborations, implementing new systems and suggesting external consultant, which involves use of AI. Again, it's a very long fact pattern, so it was not possible for us to put the entire thing in a readable fashion. But again, these are the options that we have put across to see whether how should we address the need to improve the market conditions. So second and third are seen as the options in that scenario. I would suggest that when you go back home, go through the entire fact pattern in detail. But the idea in this particular scenario was felt that if you update the mission and strategic objective, then it would be able to improve the market position. Similarly, there is a need to revise the approach or partnership collaborations. So again, a combination of these two and the rationale.
Sir, what would be the reason for this, sir? Second and third?
Was unable to
Recording in progress.
pattern, then you will yeah.
Thank you.
But primarily the idea was to highlight that even from a chartered accountant or from a CEO, CFO perspective, rather than just financial statements number, they play a very key role in developing a growth strategy for a particular entity. So here, if you would see, the core strategy of this entity is to provide high quality and affordable healthcare. Okay. As a result, when they initially started, they felt that a flat fee structure is relevant. But now, as and when they're growing, they're catering to newer generations, right? Young people, and they are willing to pay a premium for a better healthcare experience. So, for example, if you would walk into a hospital, which is which is very well organized, you have a portal or a seat where they will guide you in case of any questions. They are dedicated groups which will lead or guide you for specific health related concerns. For example, you will have one portion of the room dedicated for cardiology, one portion for for eye checkup, or one portion for general health checkup. This again experiences the entity in a very different way. Again, all these come with an added cost. So one of the objectives which they need to revisit is that if there are younger people who are willing to pay a premium, why not change our strategy to improve the presence, right? Again, from a mission and strategic objective perspective, they had not incorporated profitability, innovation, and ethical practices. So again, we can say that these are some high-level documents which the company hosts. But again, from a company perspective, these are very key documents for them because this shows what they are, what are the practices that they have. So if you have in their objective itself that I want to incorporate profitability, I want to be profitable, I want to foster innovation, and I want to take care of ethical practices, then again this tells you what this entity stands for. So for example, in my uh, uh, hometown, or many of us we associate with the brand Tata very much, right? So we're trying to have certain joint ventures or strategic alliances to improve their profitability. Okay, had entered into a contract with an entity called Vahan Chalak, right? It is a transporting agency, and the discussion is that uh, the entity Vahan Chalak, they only provide the ambulance. A Vahan Chalak can substitute another Rishi Limited, right?
He can modify it. That which means it is a productive right. Productive rights.
Yeah.
So considering all this fact, the Rishi Limited has a control over the asset.
Okay.
So how and when and where to use. So there is a lease in this particular item.
But they can change the vehicle, no? If there is a break,
Yeah.
they can change the vehicle.
But when they are saying that when there is a breakdown or that situation only they are changing, but the economic benefit that Rishi Limited only is using it. But
No, but the leased item is only changed.
okay, ambulance is breakdown, but he is able to replace the another ambulance for his use. The
But
Rishi
but that's a separate ambulance, no? It is now ambulance number 2. So my leased asset itself is only changing. So can you still say it's a lease?
Yeah, it is a lease because the Rishi Limited is how to use, where to use, direction and benefit. He is only getting all the benefit out of the lease.
Yeah.
The economic benefit he is receiving.
So basically, you are saying that if they substitute the leased item, that is not important. As long as the lessor is able to derive economic benefits, that should be leased.
Yes, sir. Suppose if that lessor is able to get the benefit out of fully the economic benefit, major economic
Okay.
benefit, if he is receiving, then that situation it is not a lease actually.
Okay.
But in this case, it's a major that benefit that the Rishi only is getting out of that.
Okay. Okay.
So I am concluding that in this contract, the Rishi it is a lease contract.
Okay. So any other thoughts, anyone? Chitra, Sanjay, Sital. Any contrary thoughts, or you agree with Swaminathan? This is supposed to be a two-way discussion. It is not a one-way. Okay. So let's see what is the technical literature. I think, as you were mentioning, Swaminathan, these contractual limitations are protective rights. They're not substantive, right? Because even though you substitute one product with another, the lessee, which is Rishi Limited, they still continue to enjoy substantive economic benefits, substantial economic benefits, right? So these protective rights only define the scope of the agreement, and they don't restrict the customer right? So in this case, uh, uh, who is directing the use of the asset, right? Why and how purpose, right? So this is directed by Rishi Limited, right? So in that case, irrespective of the fact that this can be substituted, they are considered to be, substantive rights, and this is a lease transaction. Yeah. Any confusion, anyone? Any thoughts? Any discussion points? Swaminathan?
No, sir, not from my side. Thank you.
Okay. So now let's talk about McKinsey 7S. And again, there is too much information and data. You should go back to the case digest and look at the entire fact pattern. But again, a few important things that we have put across, right? We have talked about the delivery system, right, of the country, right? What the quarterly meetings of the management is, how, what is it that they discuss? They discuss profitability, improvement in profitability. They are result oriented, and informally they also want the entities to occasionally, uh, uh, in those informal meetings, have told them to work ethically and honestly. So again, there is no stated statement, but they have just informed them informally. Again, they have a flat fee structure, but as we discussed, now there is a change of thought, and they want to uh, capitalize on the affordable market and premium pricing to be offered to newer generations of individuals, right? As far as technological advances is concerned, uh, they are trying to embrace technology, curb unnecessary expenditure, right? But they don't want to uh, uh, enter into very high cost, technologies. In the past, they have also tried to forge certain strategic alliances, but that has also failed. So overall, that's how their business structure looks like. Again, they would require professionals to have best healthcare services, and decision making in the company consider a range of things. For example, budget is one of them. Uh, they have strategic meetings. They have hired external consultant to suggest new system. One of the demerit is that all these business units that we spoke of, or SBUs, they work in silos, right? So again, if I have to talk about McKinsey 7 elements, we would need to point it out in a tabular form. So again, if you would look at, so I'm directly jumping into the responses, but if you would look here from a McKinsey 7S, right? We have shared values, strategies, skill, systems, right? Structures, style, stuff. So if you would look at one by one, right? If you would look at shared values, right? What the external consultant had recommended is that they should have a clear vision. Right now, they don't have a clear vision, right? And when they are developing a vision, it is not a one-man decision or a one-woman decision. It is a discussion with all the stakeholders, right? So they should have a very clear mission and vision after considering the feedback of all stakeholders. Now, as a responsibility, the senior management must constantly reiterate the importance of these values and beliefs, right? Innovation and creativeness should be encouraged, and they should be rewarded. But one word to be cautioned about: there should be risk, but those risks should be calculated risks, right? As far as strategies is concerned, uh, they have a high quality, affordable healthcare, and that's the reason they had initially incorporated a flat fee structure. But now, since people are okay to pay for a premium, that need to be revisited, and they should find out alternate fee structure. Again, they should improve competitive positions. They should create alliances and partnerships and businesses, right? They should strive towards greater market share by venturing into other states. Right now, as we said, they are concentrated in the state of Assam, but now I think it is important and high time that they should also look at other states to showcase their capabilities. Now, as far as those strategies are concerned, they are not casted in stone, and they should be agile and they should be responsive to changing market dynamics. So, for example, if there is uncertainty in a particular state, or if, let's say, you have import restrictions, or a particular drug or a particular medicine is not available because of various supply chain issues, their strategies should be responsive to any market level changes. As far as skills are concerned, uh, the organization have made significant investment in training and development, but there is still a need to introduce gender diversity city programs. The company should focus on retaining the female talent and the female professionals in the organization. Now, as far as the performance management criteria is concerned, they should be assessed in the light of relevant business environment. Appraisals, possibly the appraisals were not done in the correct way. It was done in the tick in the box approach. But appraisals must be more engaging, and it should be a much more disciplined approach. So generally, in case of appraisal, what happens is that you fix a goal at the beginning of the year, and you keep on assessing those goals over a period of time. It is not that you have to assess the outcome only at the end of the year, but it is important that we reassess and have a discussion with your supervisors at a periodic level, right? As far as the reward system is concerned, it should focus on innovation and growth opportunities, right? And these opportunities and enrichment should be rewarded. Systems, as we spoke, they have a silo-based system. All the SBUs work in their own manner. There is no consistency, and that has led to inefficiencies in the past. So it is important that all these silos are integrated so that the entire or the entire capacity of the group is utilized to the maximum level. So again, they should integrate systems, free up resources, which can be mobilized to other functions. The company should also analyze the benefits that the company will have from the latest systems, right? They should look at the system's capabilities, the controls, and the accuracy of data that is derived from the systems. Now, structures. The organization at present is based on strategic business units. A core process is to align those activities with the SBUs. So there should be a clear move from the silo-based approach to a more integrated structures where common functions are shared between SBUs, right? Now, as far as the style of management is concerned, they are more traditional and conventional. They have to move from that to a much more data-driven organization where the decisions are based on data and not based on some past practices. Leveraging technology is again very important, and as an entity, they are also quite keen to embrace technology in various functions. And as a matter of continuous improvement, their processes should be regularly revisited and improved as and when relevant. Now, as far as the staff is concerned, right, the gender diversity and the gender ratio should be improved, right? There should be an enabler to reduce exit of female professionals. For example, creche facilities should be provided for new mothers, right, so that they can able to manage the work and also a newborn child simultaneously, right? Another very common way where they keep on engaging is to connect with alumni, right? To meet exercises where you have alumni event where you create a bond within the ex-employee group. Yeah. So again, we thought we just discuss these questions on McKinsey 7S. So, any thoughts on McKinsey 7S or any questions? Happy to hear.
Sir, I have one clarity. Then the McKinsey's factor, we have to keep it. The thing is that seven factor. Then based on the seven factor, we have to go through the case study and
Yeah.
where we have to improve the efficiency, and
Yeah.
accordingly we need to pick the information and put it across.
Yes. You're absolutely right, because in example you will be given a case study, and
Okay.
all this information that is there on the screen are
Okay.
included in the case study. So you have to read the case study with quite amount of focus, and then understand what the case study is talking about, right?
Okay.
So the
Fine.
case study will talk about what is the current structure, what is the benefit of the current structure, and they will also give you an indication or a hint, right? What are the deficiencies? So if you would read that fact pattern very closely, you will be able to identify what they're doing better, what they should improve upon. But again, on these 7 parameters.
Okay. The seven parameter, we should use it as skeleton of it. Based
Yes.
on the skeleton, we have to fill all the muscles and nerves, all these things wherever it is
Yeah.
possible.
So again, McKinsey 7 is a management concept where they have said that to improve the long-term vision and the long-term performance of an entity, if you focus on the 7 key systems, these 7 key parameters, more likely than not you will be succeeding in a business. So that is what this principle talks about. Yeah.
Okay. Okay. I'm also thinking parallelly the SWOT analysis, strength, weakness, opportunity, threat. Here, most likely the recommendation, which means the opportunity we need to place in it.
No, I think it is not the same, Swaminathan. SWOT
Okay.
analysis is not like a McKinsey factor. See, both can overlap because ultimately we're talking about bringing efficiencies. But there we're talking about what is the strength, right? And what are the weakness and what are the threats, and obviously some are the opportunities. These are recommendations that we are making. We are not assessing the current structure, we are reading the current structure to assess and recommend what they can do better. So it is not like opportunities. Opportunity is what you have, a possibility to change. But here, based on an expert advice of a consultant who would have experience in various entities of the same industry or from a different industry, they will try to look at and tell you how you can improve a particular process. It is not an assessment of a particular process. That's what I'm trying to highlight.
Okay. Okay, sir. Based on that, okay, this is seven concept. How we are advising the company how
Yeah,
they can improve
how
from
they can
from.
improve.
Okay,
Yeah,
fine.
we're not appraising the current system. We're not saying that what is the strength today or what is
Okay.
the weakness today. We're only giving a recommendation on the 7 parameters what they can do better.
Okay. Okay, sir. Got it. Thank you.
I think there was one question again on SEBI, so I thought I'll put it across for everyone. So again, I know SEBI probably we need to brush up, but again, from a SEBI listing regulation perspective, there is a particular approval mechanism. Again, if I have to talk about related parties, first it has to be approved by the audit committee, and then for material related party transactions, it has to go to the shareholders for approval. Now, in this question, we have talked about purchase of raw materials, right? Now, the question is that whether this needs to be approved by the audit committee or shareholders under this SEBI listing regulation. I know we might need to, revise our concepts under SEBI related party more. But since we are on this topic, I thought I'll just explain the requirement so that when you go back and revise, your recall value is better, right? So as far as the audit committee approval are concerned, it requires approval of, you know, of all related party transactions. now. And what is also important is that under SEBI listing regulation, it requires a prior approval. So under SEBI listing regulation, any transaction with a related party would require prior approval. So you can't enter into a transaction before obtaining approval of the audit committee. So that's the first step, right? After you have obtained prior approval, the next step is to see whether it would require a shareholder approval, right? And those shareholders' approval are required for material related party transactions. Now, again, for SEBI listing regulation, there is a very clear-cut threshold that has been prescribed, right? So if you would look at the transaction or the threshold, they have said that any transaction is considered material if the transaction individually or taken together with previous transaction during a financial year exceeds 1,000 crores or 10% of the annual consolidated turnover of the listed entity as per the last audited financial statements, right? Again, whichever is lower. So again, what they have said is that after you obtain shareholders approval, identify whether it is a material RPT. Now, what is a material RPT? It is 1,000 crores or 10% of annual turnover, whichever annual consolidated turnover, whichever is lower. So in this scenario, I think we need to obtain approval of audit committee, and we need to obtain approval of the shareholders as well, because if you would look at from the fact pattern, they have kind of a made a purchase of 600 plus 500, so 1100 crores of transaction they have entered into, right? So this would then require approval of the shareholders. Yeah. So any other questions, any other thoughts, anything that was not clear that we discussed today? Happy to take it.
So, sir, I need clarity on what is the consolidated turnover mean here.
So consolidated turnover means, Swaminathan, the turnover in my consolidated financial statements. Okay.
Okay, including that subsidiary, all the things.
Yes. Yes. So when you prepare a consolidated financial statement under Ind AS 110, right? You would do a line by line addition of subsidiaries. You will do an equity pickup of JV and associates. Now, in the consolidated financial statements of last year, 10% of that is the threshold. So a lower of 1,000 crores or 10% of last annual consolidated turnover, that is the threshold for you. Yeah.
Okay, fine, sir. For related party also, there is a 10% limit is there, I believe, the equity shares. Like this, they have kept like this. Okay.
So that is for identification of related parties. We're talking
Yeah.
about shareholders approval for related party transactions.
Right, sir. For related party, identification of related party transaction, 10%. For 10% here is that turnover.
Yes, yes, yes.
For the disclosure requirement, approval.
Yeah, there is approval. Yeah, yeah, you're right.
All right, sir. Okay, thank you.
Okay. Any other confusion, anyone? Anything that you want to talk? Anything which was unclear? I didn't hear from many people, so maybe I'll just give a last request. Sanjay, Saurav, Sheetal, if there's something that you want to talk about, something is unclear, this is the time.
No, sir, it's okay. Okay with me.
Yeah. Okay. Great.
Yeah.
So then, Deepak, I will like to hand it back to you. That's all I think I had to cover. If there's something else, let me know. I am around for some time.
Sir, on the first case study, that related party items, how
Okay.
to answer, sir, for that?
Items.
No, that related party.
Yeah.
The case study one.
Yeah.
Related party, unidentified disclosures of the related parties.
So, see, as far as audit is concerned, Swaminathan, audit works on exceptions, right? So if you are let's say auditing uh, a sales transaction, right, and you identify a transaction, a sales contract where it is, let's say, with a brother of a director, okay, or you know that publicly available information suggests that these two parties are related, or let's say there is certain filings which the entity has done, right, that indicate certain relationship between these two parties. So it is a part of information gathering exercise that can happen through procedures on the documents which the entity will provide to you, or from an external source, maybe some filings, or maybe when you are corroborating an information with another source, right? For example, if I'm corroborating a sales transaction or a sales contract with, let's say, the payroll records of the director, right? So if you identify those instances, you can't just dismiss those instances. You have to then perform procedures. Now, SA 550, right, 550, tells you how to react in those scenarios. Basically, what they tell you is to first start inquiring. You discuss with the management whether the apprehension or the observation of the auditor is appropriate, right? Let's say the responses which the management gives, you find it to be satisfactory. Let's say in our example of sales and purchase transaction, they said that no, probably the name might be similar, but ultimately we're talking about two separate individuals, right? And you are able to vet that and you're satisfied. So again, you would stop there. You don't have a concern. But let's say you are still not satisfied with the response of the uh, management, then you ask for much more higher level of evidence, right? You would then probably send confirmations to that party asking what is your relationship with this particular entity. Let's say that party confirms. When you receive that confirmation, you will again go back to the management and ask that, boss, this is the information that I have got. Why are you not changing this disclosure in the financial statements? Right? Let's take a third option where they don't respond, right? Then we perform maybe some other procedures, right? Let's say there have been instances where you call the those parties directly and ask for certain information. Again, from an auditing perspective, it is a way to gather exercise and then to decide whether you are comfortable or satisfied with that information or not. If you're not satisfied, then obviously there is a material misstatement in the financial statements, right? For example, there is a RPT which is not getting disclosed. So then we need to assess whether the financial statements are true and fair. And if they are not true and fair, whether we need to modify the auditor's opinion under SS 705, right? Overall, net Swaminathan, this is how it would work.
Okay, because that management is not identified and not disclosed also.
Yeah.
And when the auditor is identified, some of the items is not disclosed, then it is a critical matters.
Yeah. And what is also important, Swaminathan, since we are discussing this, somewhere or the other there is a deficiency in the internal control. There is a weakness in internal control. So it is not only the true and fair view of the financial statement that is under question, but the operating effectiveness or the design of internal controls, right? That is also under the radar. Yeah.
Yes, sir. Also, I feel that when the undisclosed disclosure party is there, that the management intention is the management overriding control.
Yeah.
Which means there may be some fraud involvement in SCA 240 also will invite on this matter.
Yeah, so we need to consider SA 240. And if you would recall in the fact pattern that we have, Amit and Amod, they had actually identified a fraud risk, right, in this particular thing. But what I'm only trying to tell you that it is not necessary that every time you will identify a fraud risk, right? Even though for a fraud risk, you have to have enough evidence to conclude that a possibility of fraud exists. It could be negligence also. It could be, awareness, not being aware also. But yes, if you are able to justify that inherently there was a malified intent, or this was done deliberately to hide any particular aspect, then obviously there is a fraud risk. Yeah.
Right, sir. Because that unidentified, that not management is not disclosed. We identified,
Yeah.
and that is what that management intention is not disclosed. In management itself is trying to do something,
Mhm.
not in with intentionally.
No, so I don't want to give a default answer that only because it has not identified it has an element of fraud, right? You have to start with your fact finding. What is it that you are getting from your audit evidence? You might feel or believe something, but it has to be ultimately coming from the evidence that you are getting. If the evidence is not going to support you, then it is just a mere allegation, right? Rather than objectively concluding that yes, that there is a malified intent. So I don't think that it is appropriate to say that every time there will be a by default risk of fraud. If that is the case, then the standards on auditing would have acknowledged, and they would have said that undisclosed related party transaction will always have a risk of fraud. They have not said that. They have said that you assess. Yeah.
Okay, sir. Based on the materiality and its a perversion in nature,
Yeah.
we have to determine based on the audit risk and the risk factors.
Yeah. Yeah.
Right, sir. Thank you.
Sure. So Deepak, I don't think there are any more questions, so I will hand it back to you. You're on mute, right?
Thank you, sir, for your clear, insightful, and practice oriented explanation of today's case studies from the case study digest. In the first case study on a listed company, India's organized jewelry retail sector, you helped us how interdisciplinary concepts covering Ind AS 24 related party disclosures, section 15.1 of CGST Act with rule 28.1 on valuation, the product life cycle model, SA 550 on related parties in auditing, regulation 2ZB of SEBI LODR 2015, section 276 of Companies Act, and principles of transfer pricing. This gives us a holistic perspective on how strategic decisions and compliances requirements intervene in a dynamic and highly competitive industry. In the second case study from a super specialty hospital sector illustrated another dimension where concepts like Ind AS 21, Ind AS 116 on lease, and Section 278 of Companies Act and McKinsey's 7S framework for organizational analysis came together. This case vividly showed how operational, financial, organizational challenges demand integrated thinking. Your expert guidance demonstrated how technical standards, regulations, and strategic frameworks interlink in practice, equipping with the mindset and tools to approach complex real world scenarios. The session truly reflected the spirit of IBS paper, fostering holistic analysis, strategic judgment, and multidisciplinary thinking. We are deeply grateful for your time and commitment, especially during a demanding audit season, sir. And thank you for making these sessions such a rich learning experience, sir. Thank you once again, sir, for your invaluable contribution, sir.
Thank you, Deepak, and thank you, ICI, for this continued opportunity. I also want to thank each and every participant. I hope the time that we spent together, around 3 hours or so, was meaningful for you. And I look forward to connecting with all of you again. Thank you so much.
Thank you, sir.
Thank you, sir. Good night, sir.
Good night.
Thank you, sir.
Students, now you can raise your general queries. If you have any queries, you can raise.
Hi, this is Sheetal Agarwal. I just wanted to check, how do we, in general, prepare for this integrated business management as it is a consolidation of all the subjects put together, right? So, what are the key highlights that we need to consider for the same? Yeah.
You are discussing about examination special tips.
Yes. Yes. Yes.
Okay. First of all, use initial time wisely. Okay, start by going through the requirement parts of case studies first. Identify the ones you are comfortable with. This helps in better time management and boost your confidence early on. Don't ignore MCQ section. Since MCQs carries weightage around 40%, okay, keep an eye on them during initial reading. I am guiding you about initial reading here. In initial reading, first go on requirement part and also take care on MCQs. A wrong selection in the beginning can waste your time and affect your ability to attempt the full paper properly. Therefore, initial planning is very important. While reading a case study, jot down your key points based on questions requirements. For
Okay.
example, for example, if a question is related with Ind AS 116, mark or note down important words, figures, paragraphs, or highlight, or even you can highlight key paragraph. Okay, this early step is very important. I normally call it sketch making. You may please mute. You may need to refer to study material during the exam. Some students create their own index to navigate quickly. But I always say your best index is your mind. And it is useful only when you have good conceptual understanding. This paper is based on conceptual understanding. If you have good conceptual understanding, you can easily crack this exam. If your concepts are clear, you can scroll and find what you need efficiently. If not, you may end up with wasters spend too much time looking and still couldn't apply and affecting their rest of the paper. Therefore, start answering down Potter's five forces, all five forces. You will find enough material to connect. Then after can finalize your answer. Can you explain? It's very simple using a sim post. Similarly, India's a reputed watchmaking emotional connect rather than this helped it capture a large market share in sector that was once dominated by is it Apple or Titan